Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Eric Lynch, Managing Director and Portfolio Manager at Sharp Investments. Eric, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. It's great to be here.
You got it. Let's take a dive into earnings here. What is your biggest concern with Q1 and Q2 earnings for 2022? And what's your outlook as we start to think about 2023?
Yeah, it's a great question. It's an extraordinary time, right? We've got this 2 quarters of contracting GDP, but yet near all-time lows in unemployment. And so the economy is hanging in there. It's just not great. So what I think is more important to look at right now is the clear and present danger, which is earnings trends. And earnings trends don't look great. Basically, we grew earnings 4% in Q1. We grew earnings 4% Q2 to date. But yet estimates for the whole calendar 22 are for 9% earnings growth. So that would imply that we've got a double-digit earnings growth for the second half of the year. Given the contraction slowing down, let's say, in the economy, that just looks unlikely.
Do you think the earnings slowdown has been discounted at this point?
I don't think so. The issue that we're really seeing, Jill, is that at this point, what's kind of discounted into the assumptions going forward are all-time high profit margins of 13% for the S&P 500 for net profit margins for 22 and 23, by the way. That reflects versus a kind of an 8% long-term average. And so what you're seeing in the earnings season right now is a lot of sales figures looking pretty good, but a lot of companies starting to guide down on their earnings because of margin compression, because of all these inflationary pressures. And so we don't think that's baked in. We don't think it's baked into the market, because we're still trading in 18 times, for example, a broad-based benchmark like the S&P 500 for 22 earnings.
What areas have historically led when profits decelerate?
Yeah, no surprise. When earnings decelerate, it's time to play defense. And so historically, what you see running on a relative basis are, number one, healthcare, and number two, consumer staples. Not surprisingly, on Q2 earnings season to date, the two sectors with the biggest earnings upside surprises so far have been, number one, healthcare, number two, consumer staples. The stocks that kind of tend to lag in this deceleration periods, no surprise, the cyclicals, right? The industrials, the financials, the energy even, and exactly that's occurring this time now. The industrials are surprising on the downside so far. Again, a lot of this is margin. Sherwin-Williams had a pretty good sales figure. It's a great company, but nevertheless, they guided down on margins because they're impacted from commodity costs.
Yeah, it's so interesting this earnings season. Some of the trends, it's almost like it's not as bad as expected, and stocks are getting rewarded. It's very interesting the way the trends are playing out so far. So I'm curious to see how it will look for the remainder of the year. So Eric, what are some examples of high quality value stocks?
Yeah, this period is probably looking a little bit like 2000, Jill, where, in the late 90s, you had tech, you had growth, you had large cap, you had US, huge market leadership. And then there was a market kind of leadership rotation into kind of value, into quality for the next 10 years. And who knows what we're going to see, but odds are that there's some really great valuation kind of opportunities within value, right? And so, but because we have this cyclicality concerns about the economy slowing, traditional value looks a little scary to jump into right now. So this quality value where you've got earnings resilience seems to be a better bet. And so what we like, for example, are businesses that should have earnings resilience, the next several quarters. And you get that from a couple of areas. One is just businesses that always have that. So one example of that would be McKesson, the country's largest drug distributor. It's not a sexy business, but its utility was reinforced by the pandemic. Turns out that moving drugs, $250 billion worth of it a year, is an important job. Moving vaccines, that's an important job in a pandemic. So it's a great business, priced at 14 times versus the S&P at 18. And again, if there's a slowdown in the economy, their earnings are not going to be very sensitive. So that's one great example of a place to hide.
All right, Eric, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill. Thanks for having me today.
You got it.